how we do it.
Alright, we started the recording, but so basically, yeah. So Richard from New Orleans went to the prep school in the academy, Marine Corps, came through, Wharton investment banker, and then Veterans Alliance. Yes, the Veterans Alliance is a group of 10 service academy grads. We, to a person, all got screwed over by someone that didn't know what they were doing with the VA loan, whether it was a realtor or a broker, mortgage lender, whatever it is. The guy that I started Painter with, JD Kameen, got messed over by Navy Federal for 30 grand, which is great. They just didn't like update his file, and went to closing, and the seller basically kept his earnest money, which is technically totally legal, but a little messed up. So we decided that there's got to be a better way to do it. So what is UMortgage versus your typical retail lender? So UMortgage is technically a broker. So we have 45 wholesalers. So these guys and gals are selling like billion-dollar blocks of loans, and we're plugging you in. And so what that gives us is instant pricing authority and negotiating power. So like throughout the day, I'm getting texts and stuff from these lenders like, hey, do you have a $2 million loan ready to go? Do you have a $1.5 million loan ready to go? Like, I gotta close this. I'll give it to you at 40 basis points less than market. And so we're like, yeah, we'll take that all day. On the other side, they're selling an internal product. It's pretty rigid. They do fluctuate rates based on what JPOW says, but it's not as quick as what we get. And then they're restricted to basically their underwriting standards. So if I was an underwriter, we could never have this conversation. Like, I couldn't tell you what I look for. I couldn't talk to you and see what you actually want to do. Like, it would just be very cut and dry. You would speak to what's called an MLO, a mortgage loan officer, and then that person would pass your file to an underwriter. They're making $500 a file. Like, they don't really give a shit if you get through or not. We don't do that. We do what's called a voiceover. So you come to me and you're like, hey, I went to the Coast Guard Academy. I have no debt. I'm an 80% disabled vet. I went to Wharton. I'm getting out. I'm going to work for Bain in New York City, make 185. I'm like, yeah, sweet. Let's voice that over to an underwriter. And I'm like, hey dude, yeah, I got an 800 credit score that's going to make 185 and another $75,000 bonus. Do you want this file? And they're going to be like, oh yeah, we want that all day. Like, here's your rate. That doesn't happen on the other side. Like, they're pretty much always going to win, meaning like they're going to make their money on you. We're helping you kind of level those odds. I mean, there's, I don't have to talk about pricing theory, but like, no one's going to sell something they don't think is worth it, vice versa. Like, they're going to make a little money on you, but it levels the playing field a little bit. And we obviously are vested in this VA and veteran thing because we're all vets. So the top, 5 questions I get are like, what's the cap? Is my VA disability count as income? I bought a house when I was active duty, can I buy another? And can I buy a fixer-upper? And then the last one is like, should my spouse be on the file? So I'll cover those, but basically the VA, the VA is not doing anything other than guaranteeing the loan. And so, we all went to Wharton, so if you're a bank and you can underwrite 100% of loan to value at a certain percentage, you're gonna take that if then there's a backer that's gonna say like, hey, we'll give you 25 if this person defaults. That's what the VA is doing. So a $1 million loan, if you were to default, VA gives them $250,000, makes them whole, they take the profit. So it's really not any difference than you paying a down payment. So just think about that, like it's a down payment that you earned in effect. You can use your VA loan more than once. You can use as much as you want actually. You can have more than one active VA loan at a time, as long as you're going from primary residence to primary residence. We'll talk about that in a little bit. You can buy a condo. That's something that we actually like. So I had the first condo approved in Connecticut, and we wrote the third condo approved in New York City to my friend who's at Google. You can buy a fixer-upper, like a hardcore fixer-upper. I just bought a second house, like we're tearing down the back of it. It's terrible. It's tough to move from a $2.75 million house to a $1 million fixer-upper, but we're making it work. You can use your down payment or earnest money. You constantly hear crap where it's like realtors say, like, oh, you don't have any skin in the game, which my gruff Marine back, I'd be like, well, you didn't have any skin in the game when I was in fucking Iran, so thanks for that. So like that's something you hear, they're like, oh, you have to put money down or people don't have to give us anything. Dude, you can put 100% down and on closing, we're gonna give you 100% back. Like, it doesn't matter. Like, if that's what they need for you to get done, do it. Items can be waived. You're gonna hear like, oh, the VA loan has a no chipping paint thing, or like it has to have a termite inspection. That's false. I've bought them with every inspection, I've bought them with no inspections. I've waived finance contingencies. If you wanna get it done, we're gonna get it done. There are certain states, and I'll show you the map, that require a termite inspection, but that's for every loan. Basically, the VA loan sticks to every single federally mandated loan policy. So whether it's an appraisal or a termite inspection, like, it's gonna be as base case as you can get. And there's no size limit, up to a point. We've written about $4.5 million as our top value, but that's not saying that I can't find a lender that will do an $8.5 million multi if you have the income to support it, and you have like a plan of how you're gonna rent 4 units for, you know, what would that be, $20,000 a unit, which can happen in certain markets. And the biggest thing, this is something I really wanna stress, this is the only home loan that's earned. Again, like, no one was with you when you were on a ship, a plane, tent, whatever you did, like, you did it harder than they did it when they were selling houses. Like, so don't let them say like, oh, you have to use a conventional loan or no one's gonna listen to you. It's bullshit. Because I'm gonna get on the phone and I'm gonna tell that realtor just how well qualified you are and how quick they're gonna get their money. And that's it. Because on closing day, like, cash is green. So, and that's something that the retail lenders can't really do. But, so how do you become eligible? There's something called your certificate of eligibility. I'm not gonna like go into like what qualifies as National Guard and Reservist. You're here, you serve enough time to get into Wharton. I'm gonna assume that you probably did at least 90 days. But you need to go to va.gov, go to the search bar and type in certificate of eligibility. It pops up something like this. So this is when I wrote Chesty's loan to buy Marine Corps Barracks in Washington. So it pops up a thing and you see like, okay, cool, like I didn't know I had a loan. Maybe I should talk to my ex about that. Or like you don't have a loan or whatever. Like it just shows you what you have. Because let's say it pops and you have a loan and you've never gotten a VA loan, like that takes at least 20 days to figure out. And it's the government, so like let's tack on 40. You got 30, 40 days to close.
Does this show your inactive loans or like the ones you paid off to? So it shows previous ones? Or
it just shows what's charged to entitlement. So it does not show previous loans. So this is not my loan.
So it's like an internal VA tracking.
It's what's on. And so there's an entitlement charge. Entitlement charge is 25% of the loan value. So $1 million house, $250 entitlement. We'll get into more into that, but like that's about it. So yeah, so any previous not on there, just active loans. So this is talking about the funding fee. So basically, if you have 10% or more disability, which many of us do, if you have 10% or more, you pay no funding fee. This is a moot point. If you don't have 10% disability, then you pay at like 2% max. Like, I mean, that's, so $1 million loan, you pay $2 grand to close a $1 million loan. It's pretty good. I'm sorry, 20 grand to close on the second.
Second, and then any subsequent after that goes up.
Yeah, any subsequent use would be 3.3 or tiered down, but yeah. So, and if you have an individual loan, so in, let's pick San Diego, because I love that place. The max county loan value is 1.2653. So let's call it 1.26, or sorry, 1.2563. So let's call it 1.26. You cannot have more than 1.26 million in properties. That does not mean you can't buy one $3.5 million house. So it only comes into effect if you're trying to buy like multiple houses. So like if you want to have 10 $126,000 houses in Virginia Beach, you can do that. You can do whatever, yeah, like you're good. As long as you have some stuff we'll talk about later about like needing to move. So there's 4 pillars of mortgage: credits, assets, income, employment, property valuation, and appraisal. And these are things that like, the first 2, you're probably not gonna worry about. The 3rd one, that's why you're here. The 4th one, you can't control. So the first one, all of you are gonna have solid credit, most likely. We can write anything above 600, anything above 700, 720, 740, you're gonna get the best rate possible. I mean, like, and even if there's some extenuating circumstances, like Like I have a bunch of credit card debt right now, we're doing this house, like that's explainable, right? Like, hey, he's gonna refi when he does this, whatever, like there's ways to talk through your file. And it's not that we can't change your credit score, we can't change your DTI, well we're not, we can't get an underwriter to do it, but we can like talk you down from it. So when you get to the point of doing a pre-qualification with me or another lender, well, I can't talk to another lender, but with me, it's a soft pull. And so we don't actually pull your credit until date of closing. So like if you're a first year, so I was like, I'm going to New York City, I'm gonna rent an apartment, I'm gonna be an investment banker, and then like I'll figure it out in 2 years once I have 2 years of income verification. Well, I distinctly remember there's gonna be a guy, might have like reached out, he comes and does like a real estate presentation for New York. He's like, yeah, you need 3 to 3.5 times your income to rent ratio. And I was like, oh, well, I make 150,000 base, it's it's 12.5, so $4,200 a month apartment, that doesn't exist in New York City. I'm like, okay, sweet, I guess I'm homeless now. And that's actually what jump-started this whole like, well, I'm gonna buy a house. Because yeah, my base is 150. I got a little messed up at the end of the Marine Corps, so I'm luckily 100% from that. My wife was active duty at the time. So like we had a bunch of income, it's just that they only wanted to use a certain thing. So when we pulled our actual thing, it was like our gross income's at like $470,000. So we're like more than enough to qualify for any home that we're gonna look at. And then yeah, so another thing is you get 3, I mean I'll probably tell you something you know, but you get 3 annual credit reports. Just do it. Because like the thing you get on your credit card, like I've seen those vary like 100 points. Like I hate it because people are like, oh, Amex says my credit score is 820. And I pull it, it's like, well, Amex didn't update to your $200,000 of student loans, so you're actually at 715, which like we can work with, but like it's not an 820. So it's like, pull your annual credit report, but like really the best thing is just let me do a soft pull, and then we get you in the system and like we'll just start actually like plugging in real numbers. Assets. So your 401k, TSP, Roth IRA, obviously liquid cash management accounts, all that's good. Big thing is gifts. Like, let's say you need $50,000 to close on a house. Your parents want to give you $12,000 and your spouse $12,000, which is totally legal. That's good. They just can't have any ownership in the property. They can't have a second tier lien to the first tier mortgage. If you want to take a loan out, like your parents want to give you a loan for 50 grand at 1% or 0%, that's good. Anything in those accounts that I talked about just needs to be seasoned, which means that it can't like, you can't just like have it appear on the day of closing and like the underwriter be cool with it. Like it needs to have roughly 60 days. And then, yeah, and then on those loans, it just counts towards your debt to income ratio, which we'll talk about. Income employment, so traditionally, before we started shaking this game up, you need 2 years of income. W-2s, like hardcore, like tax return status, which is tough, right? Like you've been in school for 2 years, you're in the military before, you're making like on paper, you know, 110,000 as an 03. That stinks. You leave here with a full-time offer letter, even like today, you have a full-time offer letter because you're an investment banker, you're a consultant, you're about to go hate your life. That's sweet. I can write you a loan, like 60 days is really actually kind of the middle, like we can go out a little further depending on some things with our wholesalers. But if you're doing like a search fund, depending on how you structured that fund, you either are gonna have to wait for you to have 1099s or tax returns, or if you can figure out a way to do like a sponsored search within your search, if that makes sense. So like it's an LLC, the LLC writes you an offer letter, your offer letter says you make 125,000 a year, good to go. Disability, BH and BS, or any other non-taxed income, so Social Security, certain retirement accounts, stuff like that, is grossed up 25%, which is huge. So, and then for any of us that have pre-existing rentals, those need, this is like the one thing that can't go away, or can't change. You need 2 years of tax returns. So like, you know, that's a tricky one because you can't go back in time. But if that ship sailed, but if like, let's say you haven't done 2023 taxes yet, and you do have this rental, maybe don't take as much, you know, maintenance cost on your, and like this is something we can kind of help with and work through. And then you need 3 months of what's PITIA, which is principal, interest, taxes, insurance, and then association fees. So that's like the townhouse I own has a $500 a month association fee. So you just have to have 3 months of that in like a separate account. What's up? In separate account reserves.
Ignorant question, what do you mean by gross up, like 25%?
Yeah, so if you make, I'm making these numbers up, if you make $4,000 from VA disability, it's $5,000 when it comes to your debt to income ratio. Because you don't pay taxes on your VA disability, BH, BAS, flight pay, dive pay, any like hazardous duty pay that we had back in the day, VA disability falls on the same thing, which is huge. So, and the reason they're doing that is because your debt to income is based on a gross income level, and that like there's front end, which is just your mortgage. So that when we run some calculations, that'll be front end. Back end starts to get into like what's your insurance, what's your taxes, what's like your other parasitic things, like do you have student loans, do you have an auto loan, child care is an interesting one, stuff like that. Does that answer your question? So property evals and evaluations. So these are the states that I told you require termite inspections. What's funny is I bought houses in California and houses in Connecticut who technically both require termite inspections. I didn't get termite inspections. So there's like, there's some sway, and it really just depends on the age of the house you're purchasing, the quality, how much, how close it is to your debt to income, like stuff, there's a lot of variance here. And VA loans had a terrible stigma for like, oh, you can't have chipping paint, and like, it's just not true. Like, you can do anything you want, basically. And don't take some guy that's not me or someone else and saying like, oh, you have to use a construction loan, or you have to use whatever crap they're selling you, like, and pay 10%. Like, it's just not true. VA loans has a renovation loan that I talked about, and you pay like maybe a percentage point higher. Like, it really just depends. And so what you're doing is if you're buying a $750,000 house and you want to put $750 in it and you're qualified for 1.5, you get that $750,000 in cash on the day you close. You pay a little bit of money on top of that, but then you get to renovate your entire house. Which I can tell you, had I been able to do that when I bought this renovation, I would have loved to, but I couldn't. And then the only thing that's not waivable is an appraisal. So if your house appraises for less, it's a hard stop. There's only 2 hard stops. One comes after this. This is one of them. And this is, so 2008 doesn't happen again. But you can make up the delta with your cash reserves. And again, those can be loans, gifts, whatever. So now we get into underwriting. So the other hard stop, and this is like, you're not gonna hit this, but we see it on our active duty folks a lot that wanna like really get into like, I'm in San Diego, I wanna buy a 4-plex, let's go $3 million. If you don't have, so above DTI at 41%, which a normal lender is around 45 is where they go, so most of us are gonna be above that. You're gonna need like $1,400 remaining of what's called residual income after everything's paid off. That's like mortgage, insurance, cars, childcare, everything. Like, you need $1,400. And it's just so the VA feels good about like, this guy or gal is not gonna just totally like go underwater in this house. And so they split the country into West, Midwest, South, and Northeast, which is ironic because I've never considered Delaware the South, whatever, from Louisiana. I didn't really consider anything above like Mississippi the South, but, and basically South and Midwest are equal in their expenses, and then West and Northeast. There's a bunch of math. Just remember, basically you're never gonna be above this. If you do go above it, it's like $300 per child, but those are circumstances like we get into with like case-by-case stuff. So debt to income calculation, your front end is just your mortgage, your back end is everything else. So student loans, if you're not lucky enough to be on GI Bill or Voc Rehab, you take your balance, multiply by 5%, divide by 12, spits out a number. And if it can be deferred, so for those of us that are 100%, there is and if you didn't know this, I'm about to make your day. When you graduate, your loans are discharged. So thank you, President Trump, for that. And then, which we can, as long as we know that that's gonna happen, like, you're good. We don't have to look at your debt there. Spousal debt. So, or loans at least less than 10 months. So if you have a car payment that has 6 months on it, we don't count it unless it's significant. Like if you're like, hey, I have a Ferrari 458 that I bought when I got back from deployment, and it's $2,000 a month, like I unfortunately have to count that. Now if you're like, I have a Honda Civic, it was $120 a month, I'm not even gonna look, I don't care. So spousal debt, this is a thing. So my wife was a civilian before she got in the Navy. She had debt from nursing school. We ended up paying it off, but when we were in San Diego, I solely applied for a VA loan. And that's because when you put in her debt, it blew up her debt to income. It's not that she's not qualified or bright or not on the title of the house. Title and loan is different. She is a full owner of the house. It's just that the loan was underwritten to my name. So that's like one thing that's like, if you or your spouse has a bunch of debt, then like that's something we should play with. If you don't have debt, like we'll put you both on and boost the worthiness of the file. It's fine. There's something to think about. Depending on which wholesaler, and again, like how close you are to your DTI limits and stuff like that, childcare can or cannot count. And then same thing with commuting cost. Commuting cost is a wild thing. What do you think the max distance is for commuting? This gets into like remote work. Just give me like your rough number per month that you can drive in your car before we have to look at it. How many? Oh, and no. How about an exponential number of that? 4,500 miles. If you're driving 4,500, 60,000 miles a year, or 54,000 miles a year, then I'm gonna start to be like, not me, the underwriter start to be like, hey, like, I don't think they're commuting from Denver to LA, like, daily. Like, this is probably not good. So, keep that in mind. Again, like, these are things I wish I had known as a first year. You'd probably catch me in Vail right now. So this is what like your typical DTI looks like. Unfortunately, we're not gonna be here for a while. We're probably somewhere around here, and these rates vary literally like 8 times a day. So your front end DTI 40%, back end is 70. In very particular cases, we can get above technically 69.9, but like you better be bringing like 400 grand in cash to the table and like a big bonus in the front end, like backside. Like this is stuff that I can talk to them about, but it's like they're not going to look at an 80% DTI unless it's like he's buying a multifamily and this one unit was underutilized and it's actually a market value of double what it is and it's going to instantly break it down to 60. Like there's some play, but basically base your disability, whatever debt you have, gives you your gross. And then you're multiplying by your percentages and doing a simple payment Excel thing to find where your DTI shakes out. I hear this a lot, multiple buyer scenarios. So if you're here and your significant other, partner, whatever, is a vet as well, you can each use your VA loan. It doesn't double your entitlement, unfortunately. So like, let's say one of you owns a house or both of you own houses and you want to double up again and buy another big old house. Unfortunately, you can't do that, but it does change the amount of entitlement it starts to do. So remember your entitlement's that 25% of your purchase price. Non-married co-borrower is acceptable. So what that means is like if you have a civilian girlfriend, boyfriend, fiance, whatever, and you want to go together on the loan, you can. I would tell you it's easier. And this goes to like your personal stuff, but like it is easier just to get paper married, like legal married, if you're on that path. Like if you guys are engaged, I'm not trying to defraud the financial institutions, but if you're like on the path of getting married, like getting courthouse married, and this is like a very normal thing for us, right? Like my wife and I are courthouse married. Get courthouse married, get through the loan, then have your big ceremony later, you know, personally, it made the wedding a lot more fun too, because I wasn't like having to sign my name, very inebriated. Single family loan, so this is where it comes in. The VA has 3 missions. It's to give vets medical care, to give them training, education to get jobs, and to secure housing. So they were like really failing at number 3 all through 2020, which is why they like changed all these rules in 2021. But the one thing they didn't change is it is your primary residence. It's not a rental property, it's not a vacation home, and like, this is something that like they're pretty serious about. I think I told Bill, like I've only seen them actually pull a loan once, and this dude was egregious. Like he owned, let me think, either like 4 or 5 houses total, but I think it was 4 total, 3 of them with the VA and 1 with the FHA, and they were all in Virginia Beach. And he was like, he would move into one, and so this is what I'm talking about, this change in circumstances. He would move into one and be like, oh, this neighborhood is terrible. And then he would literally move like 2 houses down and be like, this is much better. 6 months later, oh, it's terrible. And like, they're like, hold on, dude. Like, they're literally within 10 miles of each other. Like, this is not working. So they called him, like literally called him, but also called his loan. They're like, you owe us $700,000 today, like, or we're taking your house. And we like got him through that, but I was like, I'm not gonna let you get in that situation. Like, I mean, if you want to, I can give you some advice, but like, that's not my advice. We were able to like roll his properties in a commercial loan and like get all this stuff done, and it ended up costing much money. But like, don't try to don't like, this is a big enough benefit, and I'm gonna show you what you can do with it, but like, don't necessarily take advantage of it. Now, if you bought, like, I bought this giant ass house in Greenwich. 6 months into banking, I hadn't seen my son since his birthday, other than like 2 days, and I was like, I'm not doing this anymore. And that's totally fine. You write a letter, you're like, hey, I'm in over my head, I don't want to do this job anymore. And they're like, cool. And then my wife and I left, we bought another house using her VA loan, and we put renters in that house, which ended up becoming the greatest investment we've ever made. But that's totally cool. Like, you can make mistakes. This is not an infallible process. So
For your buddy who bought the 3 houses at Virginia Beach,
his dad's an admiral, by the way. He's a phenomenal person, and he's brilliant.
did he get in trouble because he had 3 VAs, or just because he had that many houses?
It was actually the FHA that triggered the.
Okay.
It was something. I didn't write that loan. We didn't write that loan, so I don't know what actually triggered that. I just know when they looked, they were like, "Wait a second, you bought 3 houses." I think it was 3 houses within like it was well under the 1 year.
Yeah.
Because if you make it 1 year and a day, regardless if you have changed circumstances or not, you can, like, if your house is under the county limit, you can go buy another house. Like, that's totally good.
But if he had flipped those VAs to conventionals,
Yeah, that's fine.
then they wouldn't have.
If he had flipped, so if he had flipped those, it would have released him from his, that certificate of eligibility would not have showed the houses on there. You could go within under a year, and that's all fine.
But it was still the FHA that got him.
Yeah,
Not
it
the
was
VA.
also because he had all 4 of them at once. Yeah, and they were also all with the same bank. Yeah, it's like, come on. And then one cool thing that's we've done is traditionally you can't buy a commercial property. However, if your residential property has a single commercial building attached to it, or single commercial dwelling attached to it, cool. That's a residential with an accessory commercial space attached to it. So if you happen to buy a warehouse that has an apartment in it, and that warehouse is $4 million, and the apartment is there too, and the warehouse, triple nets for $300,000 a year, sweet, you've made a dope deal. So just think about that. Don't go find a warehouse in East LA and then call me and be like, I want to buy a. So I've told you that DTI calculations. Multifamilies. This is one that's super interesting. If you do not have 2 screaming kids and you can deal with tenants and you want to do this, it basically, if you qualify for, I'm just gonna pick numbers, if you qualify for $1 million, and then you want to buy 4 units. So you qualify for 1 townhouse that's $1 million, and then it's a new build, let's say, I wish Rasan was here, because his townhome would be like a perfect example, because he could have bought all 4. But you buy that one new build, and there's 3 within the same spot that can go in the same transaction. That's a big thing. Then you get to create a lease based on market value, and then we take 75% of that proposed lease, and it reduces your DTI. So if, again, you're buying $1 million place, you actually get the buying power of 1 million plus 750, 750, 750. So you're 3.25 right there. It's like, that's pretty sweet. And then you have 3 other people that are paying on your loan. So for me personally, I wanted to buy this 3-unit townhome in Stamford, which is New York, Greenwich, Connecticut, Stamford. It's 45 minutes from Grand Central. They were rented for 4 years, long-term tenants, $7,000 a month. The payment would have been 19 grand. I would have moved into one, instantly rented the other 2, made like $5,000 out of pocket, and had a $3 million townhome unit. Like, that would have been good. Yeah. Oh, this is a funny one. So your likelihood of success as a landlord. There's all these like things in quotes, because it's like, this is what the BA says, right? Like, what the hell determines the likelihood of success as a landlord? Was it being a platoon commander in the Army or going to Wharton? Like, I would say yes. So like, we're gonna be able to push you through as a likelihood of a landlord. But if they, let's just say they were like, this person's never managed a house before, I don't think they're gonna be able to do it, then you just need to have a, this should be in quotes too. You need to have a property manager in place. If your realtor is your property manager, and then the day after, she's like, I don't want to be your property manager, shit. Like, I guess you gotta manage it yourself. So, you just need it on paper. So this is that DTI, that debt to income calculator I was talking about. So let's just look at your polls here. So 6.5, like really you're gonna be like here. So let's look at, so we're at 3.3 or 4.8, right? So your buying power single family for those numbers is 1 million and 1.5. So you're getting like a 3x if you want to buy a townhome. If you want to buy a multifamily. So this is my person's thing. So I thought I was going to be an investment banker for the rest of my life. I was like, maximize my DTI. Like, let's go hard. So I was a front end of 55%, which is high. Like, that's like real high. That I even was able to get a lender to do that at that time was big. So as a graduate in Connecticut, it was 42-minute door-to-door commute to Midtown. I bought it for 2.725, which is a huge number. This is not me bragging, I'm telling you, like, maybe don't do this. But the Zillow estimate right now is 3.2 million, so that's pretty sweet. That's a 2.6 annualized return. So I run a private equity firm as well as doing this. So I'll take a 10% annualized return on a brand new house 8 days a week. My pity, including association fees, is right at $15,000. As a rental property, it's right now on a 36-month lease for $17,000 a month, which nets me a 6.38 cap rate, which is pretty good for those that have taken the real estate class. 5.5 is usually the norm. You know, and if I sell it, my Peyton is at Columbia Business School now. If we sell it when she's finished, I will get a 50% ROI. And it's, when I say my ROI, realize that my cost to acquire this house was $50,000, which is ridiculous, right? Like, no one in the world, other than us in this room, gets to buy a $2.7 million house for $50,000. And I lived in it for 10 months, you know, paid interest, taxes, insurance on it, that's also a cost. Factoring all that in, if I sell it at the current Zillow price in a year and a half, I'm like $450,000. It's more than I made as a banker. Like, it's a whole hell of a lot less work. I mean, I'm a big believer in property. Obviously, I've shifted my entire life to do it. But there are ways to make this work. Now, I'm not telling you, and again, every month that I stroke a check for 15 grand, I felt like I was trying to breathe out of my rear end. Like, it was like, and especially because my base was 12.5. And I was just counting. I was like, please make this bonus big. in my years, the bonuses were big. This year, the bonuses were not. My friends that, and I didn't have anyone else in my class that bid off this big of a nut. Again, like, I tend to kind of go to the polls and everything I do. But I was like, all right, what's the max? I can get approved for, my max approved was 2.8 billion. I was like, oh, I can get 2.8? Dope. Here's 2.7, let's go. Don't do that. Like, unless there's some, so I'll tell you what I like thought about when I was buying this house. The place, the townhome adjoining it had been rented for, it was built in 2019, we bought it in 2022. It had been renting for 3 years for $14.5. So I knew that I could, like, even at a 25% market reduction, I was not gonna technically lose money. And when you look at losing money from an income tax perspective, it's interest, taxes, insurance, and association fees. Anything above your principal, like anything above those, including your principal, is technically taxable, but that's where your depreciation comes in. This is a brand new house, right? Like, the walls are great, all that stuff. I get to depreciate it at the market price, well, whichever's higher at the acquisition, right? For me, my market price is higher, so I get to depreciate it 27 and a half years and deduct all my income from that. So the house is an LLC, my kids work for the LLC, my 2.5-year-old and 11-month-old are out there on Instagram, like, hustling, trying to get people in this house. I pay them $7,000 a year to their IRA. I pay them another $5,000 to make up the gift. Actually, right now the gift is $18,000. It's like, you can structure your entire family life of giving your kids, like, I mean, you want to talk about, like, I don't want to derail this conversation, but, like, if you want to set your kids up for financial success, which is I know why I came here, you know, like, I grew up well, but, like, not what I'm trying to do for my family. You start a Roth IRA the day they're born, put them on your credit card the day they're born. By the time they graduate, so they'll have like $3 million if you just account for like 8%, you know, annualized return. By the time they retire, if you just put in like that, just until they start to go to, you know, let's say they follow your path, they go to Wharton and they're 30 and they can't put in the Roth IRA anymore, they're gonna retire for like $3 to $5 million. Like, that's pretty sweet. You've changed your kid's life because you started putting in, you know, $7 grand. Like, it's not a small amount of money, it's not a lot of money. Yeah, we can talk about that stuff too. But, so now what I'd like to do is a case study. So if you didn't have a chance to fill this out, it's basically just like, well, the top bit's some contact info. If you want to get in touch, cool. The bottom bit is like where you're thinking about going, how much you think you want to spend. This is just like something you, like, you know, some rough math. Like, I make 150, I think I want to buy $1 million house, or I make 175, I want to buy a $1.7 million house. Like, split that in. If it's a single family, multifamily, a condo, a boat, we can't, unfortunately, VA loan a boat, but there are lenders that do. Not a VA loan, just like conventional loans, RVs, land, stuff like that. And then, trying to think what else is there. And then, like, any questions?
Yeah, on the topic of land, can you do land with a construction loan, or how does?
Yeah,
I know
so
that's really-
land, so you'll hear land loans, raw land loans, construction loans. The land loan and the raw land loan are basically the same thing, and I can't write one because it's traditionally, it's a really hard asset to do anything with, number one. Yeah, there are local credit units that will, but you're gonna pay. So I diligenced a 70-acre island, actually, in the Chesapeake Bay, which would have been the coolest, like, tiny home community. But when I got to the financing stage, they wanted like 15% APR, and it blew up the project. So it depends. Depends on how remote it is, how easily they can flip it, you know. But they were just like, there's a lot of risk for us. Like, this is what we think. And it's for that one, it was like 25% down. On the construction loan side, if you find a builder who's building a spec house, Like they're like, hey, this house is gonna be $2 million and it's gonna be finished on May 1st, 2024. Sweet, you can write out a VA loan on that. But you cannot speculatively build, meaning like I can't give you a loan for 2.4 and then you go find a builder and then you go do this stuff. It kind of has to be set in place, and that's the same thing with the renovation loan. So that's the one hiccup that I see with the renovation loan so far, is that if you're in a really hot market, which right now a lot of places still are, even though we're in a greatly reduced inventory. If you're in a very hot market, it's gonna be tough unless you put down a bunch of earnest money or like give something to make that seller feel good, because it is gonna take a while to get a contractor to make a bid on renovating that house. Let's call it an extra 15 days. And then like, that's the value that we use to write the loan. So if you can get it done in 30 days within that close, sweet. It's just if it takes longer than the traditional 30 to 45 day close, that's when it gets weird. All right. Any other questions real quick? I'm gonna pull up this form and see. What's up? All right. Ooh, Philly is getting the vast majority. Philly is actually a great place. Obviously, you're all intimately aware of it. But you can also get like a townhome. Like, there's actually a townhome on what's not what's the name of that? Anyway, on one of like the little like block long parks, it was like 1.3, and needed a little work, but like now the house is probably worth 3. Most people are interested in single families. How can I structure multifamily? How much time to use it? How should I approach buying a house when I don't have an official start date yet? Expected August, September this year. If you can get a no later than like, even if it doesn't stick on their side, just if they, if you give it to me and it says that you start on July 15th, we're not gonna call your employer and say, are you starting on July 15th? We're gonna take that they're giving you a date that is realistic. If it says no later than December 1st, we can work with that too. Like, there just has to be a little structure in the letter. Like, you can't just be like totally open-ended, like, you will start in 2024, like that will work. And it looks like most people are in the 750 to 1 million range. So, can you use your disability rating to pay less fees? What is that? If you don't want to call it up, I think what that's saying is pay less fees. So on the funding fee side, if you have 10% or more, you pay no funding fee. That's that. It doesn't, the only thing that matters on the rating scale is once you get to 100 in certain states, and like running off the top of my head, like Alaska, Hawaii, California if you make under 125,000, Texas, Florida, Alabama, South Carolina, Tennessee, Wyoming, Montana, I think Michigan, Maryland, Virginia, New Jersey. If you're 100% permanent total, you pay no property tax. To put that in perspective, in New Jersey, property taxes are insane. They have great schools. I'm not necessarily a fan of New Jersey, but like they have great schools. If you're 100%, you move to New Jersey, you save 50 grand on a $2 million house, all day.
But are most of those also like income based if you're over X amount?
No,
like
the only
Pennsylvania
one, the ones I
is.
just named, the only ones that I really deal with frequently is California, and that's taxable income. So if you own a bunch of rental properties and they're all depreciative, I don't know if that's the word, depreciating, and you don't have like W-2 hard, or not, tax return hard income, then like that's what California looks at. So, or if you have a bunch of retirements, like, probably like 25 years from that point, but like, If you have a bunch of retirement accounts that aren't taxable, you move out to California, you pay no property tax. Now, like, that changes, right? Like, what state just changed? California actually just changed in like 2021, I think. Before they would tax everyone, now they don't. Who else changed? Connecticut is talking about changing, but like, we'll see. Looking to buy prior to moving, yeah, that's fine. So there's something called the occupancy minimums. So you technically need to occupy your house within 60 days of acquiring it. Technically. There's extenuating circumstances. Oh, I'm taking an extra class at Wharton. I'm not moving till August. Cool. Like,
So what if you work in San Francisco, but
I love
you
this
want a
one.
house in sort of like,
Fail.
or like LA, right?
Yeah,
Like,
no,
it's
that's
too
cool.
far to commute, like,
No,
what is the
no,
distance?
dude, that's not.
Okay.
No, because you can take the Pacific, was it the Pacific liner or whatever on Amtrak? I'm not gonna tell you that, well, I'm not an underwriter.
But is your, like, where you're actually working, is that dependent on like?
If you have a remote policy, then it changes a lot of stuff. So if your offer letter says, and this is something you can submit after the fact. So your offer letter says you're in the office, you know, or you're working in San Francisco, and then you have a remote policy that you submit aside that says that Mondays and Wednesdays you're in office, the rest of the time is remote. Dude, you could live in, like, as long as you're not going over like this aggregate distance stuff that I talk about, like 54,000 miles a year,
Yeah.
you could live in some place and hop on a plane and go, technically. I mean, like, you just have to, and this is where that voiceover thing, and this is something that we really wanted, particularly I wanted to help you guys, is like, I want to be able to say, like, to a person that's lending you money, like, no, like, this person works in San Francisco, he or she wants to live in San Diego, right? Like, it's an hour flight. Like, he works on a computer, like, the dude is competent, like, let's write this loan. And most of the time, they'll say, like, okay, cool. Now, if you're like, I want to live in New York and buy a house, or my job's in New York and I want to buy a house in Vail, right? Like, you can tell where my mind is. Probably not gonna happen. Like, you got a 3-hour drive to get to the airport, to then get to New York. It's just like, even if you're on if you're like maybe twice a month hybrid program, you might be able to swing it. Again, there's so much variance. And like, this is why, like, I get questions all the time, like, what are the rates right now? It's like, dude, I get 45 different lenders updating rates 6 times a day. Like, I can't, and your credit score can vary 100 points depending on what you're telling me and what I pull. It's like, I can't give you a rate, like, unless you actually want to do this thing. With that, there's so much variance in job offers, in the 45 underwriters, but like, there are ways to make it work, basically with every situation. And it's like, just like, start thinking it through, and we'll go from there. Okay, so we'll just do.
I have a quick question.
What's up?
So if you have a VA on a single family,
Yes.
but you want to get into the multifamily.
Yes. You currently have a VA on a single family.
I have a VA on a single family in Virginia Beach.
Cool.
Or Chesapeake, so right next to Virginia Beach.
Yeah.
But looking to get into the multifamily space, is there still like that cap? Is there the cap?
When did you buy?
2019.
Okay, so in 2019, Virginia Beach, rough numbers, the limit was like 570 grand, I think.
Yep.
Look at that, that's fucking good. It's my math brain. 570 grand, right? So what did you buy your house for?
450.
Okay, so you're 450, 570, 120. So you're at like 76%, right? Is that right? 450, 570? Yeah. So you take that percentage, that's your percent utilized, and then you want to buy a multi now. So unfortunately, this is the only unfortunate thing I'm going to tell you, is that it goes to your single family. So your single family today is 1.2653, highest in the country. So let's say you're picking, where do you want to go?
Probably that area, maybe North Carolina.
So in that area right now, single family is like high 7s, I think it's like 754. North Carolina, Charlotte, there's certain areas that need a little higher. Let's say DC, just for easy numbers, so it's 1.2653. you've got 28% remaining, so, or sorry, 22%, so 22%. So you have $278,000, you don't need a down payment, so, and some change, it's roughly 278. So let's say you wanted to buy a $1.25 million multi, so that's plus 1 mil. This is the only thing you pay down payment on, you pay 25%. So for $250,000, you can do that. Now here's some interesting math. Is that what do you think your house is worth in Virginia Beach?
625,000.
Dope. So you have about, what'd you pay for it? 450. How much do you have remaining?
380 maybe.
Sweet. So you also have $300,000 in equity in your home. You can do a HELOC up to 9%. Now, like, I'm starting to find a wholesaler to write a HELOC, but like, that's not my business. You would go to like, whoever, maybe never, who has your loan?
Wells Fargo now.
Okay, yeah, they probably either do a cashback refi. I'd probably stick away from the cashback refi, because HELOCs, you can pull out money as you need. So let's say we approve you for a $300,000 HELOC, and you wanna buy a 1.278 house, so you do that $250,000 down. You just take your $250 on your HELOC, so you're getting your HELOC at like 7.25 probably. So you're getting that money at 7.25. This is where, remember, you can borrow money for your down payment. So you're getting that money at 7.25. We add that to your DTI. What job are you gonna do? Do you have any?
I'm still active duty, so I'm going back.
Oh, sweet. Yeah. So you're, I mean, what are you, lieutenant?
I'm up for commander this year.
Oh yeah. You'll be. You can definitely go multifamily. What kind of skin lotion do you use? Okay, fucking wrinkles. That's an 03. Yeah, so there's definitely a way to make that work, and probably a way to make it work with no down payment. Your worst case, and even outside of this, like let's say we can't get a structure in the VA, FHA is a thing, you definitely qualify for that. You can 5% down, pay like a joke of PMI, private mortgage insurance. If you don't do that route, there's like 5% down conventionals, again you pay a little PMI, not a big deal. But there's ways to make it work.
Well, with circumstances like that, would you recommend just playing the rate arbitrage game and saying, hey, if he's at that one in 2019 at like
Yeah.
2.83, 2.75,
Yeah.
just go ahead and refi a conventional right now, and then you're full open on your VA.
Yeah, I very rarely see it make sense. It usually makes more sense to do a HELOC because you don't need all the cash. If you were like, it comes in this very, like there is a zone when it starts to make sense to do the full on refi, especially if you can, let's say you've had tenants in it or something for 2 years, then like, if you refi it as a commercial property, so you would leave in 25%, you do a cashback refi, you get some cash back. If that brings you to a level, but like most of the time I don't see it to where you get enough cash back and be able to leave 20%, 22% equity in the house. So that's what you need to not pay PMI. Most of the time in order to get up to that level, we're using HELOCs. But there's ways, there's tons of ways. Let's see if there were any others. Did you get, I like this, did you get your student loans forgiven where they grad plus loans or smaller grad? They were all the above. I lived here, my wife lived in DC, we had 2 houses, we had 2 kids, we had a nanny, like I was commuting all the time, I had a shit ton of debt. And then second year, I got a call from someone who was like, hey Will, we're discharging your loans. And it was like, what? Like, what do you mean? They're like, yeah, like, it's a new program, we're discharging your loans. I was like, oh, I graduated in May. They're like, oh, that's cool, just call us in May. And literally I called the number back, they discharged my loans. It was incredible. How much buying power do I have? If we have like 5, let's do a little. Okay, so spouse is starting, a medical program, a veterinary program, that's cool, at Penn. Are they a vet?
Yes.
Cool. So he or she has, do you have a job? Are you second year?
I'm a first year.
Your first year.
Yeah. But we're not really looking to buy until I graduate, so I would.
How long is the program? 3 years?
His program's gonna be 4.
Oh, yeah,
Yeah.
cool, yes. So I can't use yours, cause you don't, and is it a year, is this thing a year-round program? Yes.
Is it a what?
Year-round?
Oh, yes. Yes,
Oh,
it is.
cool,
Yeah.
okay, so because it's year-round, and he's there for more than a year, we can look at his, cause he'll receive some kind of BAH, right, or stipend.
Yeah, he'll also be already.
Oh, sweet, yeah, so we can.
Okay.
With you, we can't, because your program's only 8 months a year, so your
Okay.
BAH isn't consistent. So that's the only, like, if it's a year-round program, you can. And then we both use part of our VA loan. How do we calculate how much entitlement we have? Did I answer that question with whoever that was?
Yeah, I
Oh, cool.
understand it.
Okay.
Yeah.
Yeah, and that's my contact info.
Okay.
Text me, we can run out some extra numbers, but let's look at, so it was Philadelphia, $1 million, and single family was the shakeout. So let's see what we can find.
Hey, well, as we're doing that, and guys, feel free if you need to go. Leave. Hey, help me need to. I just want to say thanks.
Thanks, Bill.
That's Bob.
Thank you.
Appreciate it. It's great knowledge.
Thanks, guys.
Back to conversation, but if you guys need to leave, please go as needed.
All right, cool. So. So that house I was talking about was actually on Fittler when I was thinking. And that's where I lived when I was here. So like, let's check out this place. Looks awesome. Or maybe it's, which one? The townhouse or the condo? Condo, all right. So 125. So, and like Zilla's pretty good, right? Like if you find a house, and it spits out like a property tax number, usually it's pretty good. You know, like really like if you're like full on diligencing, like go to the county tax website and pull it, and like we'll get to that part when we start looking at like back end DTI stuff with us. But like this is saying like 12.58, I believe that. That's about that. So the national average is 125 basis points, 1.25%. And then on a home insurance side, it's about 0.5% usually, but there's a lot of variance there. For instance, if you're in Florida and you have a $400,000 house, expect to pay $4,000 a year for homeowners just because there's natural disasters and stuff that occur. If you're in Wisconsin and there's no real natural disasters, you're probably gonna pay $1,000 a year. So there's a lot of variance on the home insurance side. So, okay, so we're at 12.588 there, and a 1.25. So, let's say that, so what do we want to make our yearly income? For someone staying in Philly, let's say they're going to work for, I don't know, what's that? Alvarez and Marcel, I think it is. So they're going to be a consultant, they'll make 175. let's say their spouse is working at 100, let's say their VA disability at 80% is $1,900. Remember that gets grossed up. So because they're not 100%, let's factor in that they're gonna have student debt. They have a nice car, right? Like they're gonna be staying here, it's good. And they have a Peloton because, you know, they're a millennial. So then we come over here, we're gonna look at our tax estimates. Let's call this 1.25. Insurance, there's gonna be no HOA on the townhouse. So our front end DTI puts this house right about 35%, somewhere in this range. So let's just pick, just because I know that like right now we can do it. Let's look at 6.5. So we're gonna pick 6.5%. Basically, we're just gonna figure out what our payment is. So our payment is our rate. So remember, it's rate divided by 12, number of periods is 360, present value is the negative of 125, future value 0, type is ending, so that's that. And then we're gonna do the same, so that's gonna spit out one extra 0. So that's gonna spit out that 7,900, this is your front end. And then you have your taxes, your insurance, and then that's probably about it. But for that house, unless you have like, sometimes you see it with like historic assessments. Again, this comes into like the variance of the individual city. Like, I don't know if Philly does it, DC does it, where they'll say like, all right, your house has to have a new roof and it has to be copper. It's like, that sucks. It's like, plan for that stuff. If you're moving to one of these places that has that, like, that's another thing that pushed me towards Connecticut, vice New York. Like, they're very laissez-faire in Connecticut. So, our taxes, so again, this is the 125. And that's per year. Insurance. And this comes out to your pity. So you'll hear people in this business talk about your pity. Like, they'll be like, oh, your pity is too high because your DTI, whatever. It's like, it's just weird. That's just your mortgage payment. Because in these initial stages, everything goes towards your escrow account. So like an escrow agent handles it. And that's just like your interest and taxes. So again, so this gets us to a back end of that number divided by gross. We're at 42%. You get written all day long, 10 days a week. Like, not a problem in the world. For this to start to matter, I should have built this a little more dynamic. For this to start to get like sketchy in this scenario, we're almost doubling our purchase price. Yeah. So even at 2.5 with this particular person, so again, this person's 175, spouse at 100, a little bit of VA disability, you're at 2.5 on a back end, and that assumes some debt. I mean, like, this is some cool stuff that we play around with a lot. It's like, so this would be very tough to get underwritten. Like, even if you had a bunch of cash reserves, like telling someone like, yeah, I'm gonna be, because remember this is before income taxes. So telling someone like, oh yeah, I'm gonna go pay off my house and my income taxes. Oh, by the way, it's at 30%, but at a 7% DTI, like, it's gonna be tough to convince them of that. So it's like, oh, well, let's wipe out that car, let's wipe out that Peloton, then you're at below. So it's like, if you have 16 grand in your car and you're making $650 payments, you have 400 grand in cash, I'm probably gonna advise you to pay off your car, bump your DTI down. And what's cool is like, you can even get like, depending on where you shake out, like, you can get the seller to pay for things. Like, the seller will pay your closing costs in certain places. So.
What about like bonuses?
You need 2 years,
2 years?
unless it's guaranteed. So I've seen offer letters that say like guaranteed performance bonus of $50,000 plus 1% of whatever it is, gross revenue. 50 grand can count. The variable amount, you have to have 2 years. After that 2 years, you take an average, which is sweet. So like if you bought a house now, and then 2 years from now you want to buy another, you have 2 years of bonuses, cool. And that's 2 years including your stub. So stub bonus is that first 6 months. Let's say you graduate, you start in June, stub bonus, right? The second June of that date, we take 24 months annualized, whatever bonus that spits out, which is great. Any other questions, guys? Well, I hope that was informative. Again, I'm Will. I'd love to help you guys however I can. You know, some things that I wish I had thought about when I was in your shoes. It's not like I'm like vastly, you know, removed from this space, but I can tell you that, like, I was stationed in California for 4 years. My wife was stationed in California for 5 years. Like, we love California. At the time, it was like Qualcomm, Callaway, and like Toshiba were recruiting out in San Diego. Had I known that I could have bought a house in like Carlsbad, worked a remote gig to someone as an SF, and not had to do the grind. Now it worked out, right? Like, life is cool, and like Greenwich, Connecticut is not a place I'm going to complain about living, but it's not San Diego. And it's not where we want to be long term. So it's like, I don't know what the breakdown is of like first and second years. If you have friends that are first years, like, oh, I have to go be a consultant in New York City for 2 years. It's like, no, you don't. And not only no, you don't, like, you can go be a consultant wherever you want, take maybe a little less pay, go be a consultant in the Midwest, if that's where you're from, buy a house and like start your life. Instead of like going to New York and doing this like classic, like, I'm just gonna beat my head against the door because I'm a veteran and I've done it for 10 years. Like, you don't have to do that. That's all I know. Yeah. And like, I'm biased, right? Like, I built this thing. We have the bar to entry to be a mortgage lender, real low. They didn't go to work. They didn't go to service academy. We have 10 service academies. Our least educated dude is a prior gunning with a master's degree. Like, we are not the team that you're gonna find at Navy Federal. And that's just like a plug for us. And we legitimately want to see people like do something sweet. You know, we've done, you know, like, we've done like similar stuff with service academies, just because that's where we're from. I'm not gonna get in the whole like VMI versus West Point versus whatever. Like, I don't really care about that. It's just like the midshipmen, they're coming out of their active duty, so they qualify for these things I'm talking about with these offer letters. So we're able to get people houses and multifamilies when they're 22, and then they get out, they've got a house that's doubled in value, they've been paid the whole time, and it's like, my whole thing is like, you know, I told you, like, I didn't come from nothing, I didn't come from a lot, like, but I bought my own car, paid my way to college, like, I don't know what I'm gonna do with my kids, but like, if I can hand them a $3 million rental property when they're 30, and be like, hey dude, like, you wanna go join the Peace Corps or be an E-Dog in the teams? Like, you got it. Like, you can do that. You don't have to do what daddy did. Like, you've got it taken care of. So like, these are just things I think you should start thinking about maybe, and saying like, do I really wanna go live in city X? Or should I live in suburb of X and like buy a townhouse, buy a multi, buy a commercial space that has an apartment? Whatever it is. That particular, the commercial space stuff is pretty cool. There's a, in East, so I have family out in LA. In East LA, there's a dude, he bought a warehouse, built his house above the warehouse, and he rents out the bottom. I think the bottom 2 floors had one to a clothing company, and they pay like $100,000 a year net, triple net. So triple net means they pay for everything. Maintenance, taxes, insurance, everything. They're literally just like giving this dude $100,000. And then the bottom one they pay like 300 grand, 'cause it's a much bigger space. So this dude lives up top. Now he was like, you know, East LA is not a nice place if you haven't been there. But like, he lives up top, he's making $400,000 in this like big, cool industrial building. That's pretty cool. If you could find a place like that, I haven't seen it come across my desk yet, but like, there's someone that's gonna do it, it's gonna be a Wharton grad, so. Any other questions?
Big picture,
I love big
when
picture.
do we start like,
Thinking?
contacting you, or like,
Yeah.
I'm not even looking for a house, I don't even know where I'm going, like, what is like the steps?
Yeah, so because this goes back to the softball. So I've specifically structured this business in my mindset is when I was here, which was like, I don't wanna do a hard pull and screw up my credit, right? Like you walk into a dealership, buy a car, they pull your credit 5 times, you take like a 10-point hit, it sucks. I didn't wanna do that. So that's why I then had to become a broker, which is a little like extra step. And then we found UMortgage to partner with because they already had 45 wholesalers that we could work with. So it's like, that was that. So that's a softball. I would say since it doesn't hit your credit, you do it like, are you first year or second year?
Second year.
Yeah, like do it now. Cause like, the other thing is when we start looking, right, like, I don't know, you give me some number, you say, I think I can make 150 grand. And then rates go up 2%. I don't think they will. I actually think we're gonna see pretty stable rates this year, especially after these past 2 weeks. But you're like, I think I'm gonna make 150. And I'm like, okay, cool. Like, I think we can qualify you for this number for single family, this number for multi, and then it just gives you some ammo, just to start to say like what is 1.5? What does 1.5 look like in Denver, Colorado? Like, okay, cool. Like, what's it look like in Miami? What's it look like in New York? Nothing. Okay. What's it look like in San Francisco? Oh, that's 10. Like, what's it look like in Texas? Like, whatever. And so it's just like, you can start to shape, like, God, please don't, like, move to, I don't know, what's the worst place? El Paso, Texas. Was anyone in the Army? Bill, I know you were. They would station in El Paso. The first fight I ever got with my wife was in El Paso. We'd been married for like 6 days. We got in a fight in El Paso, Texas. Because I was a lieutenant in the Marine Corps. They wanted to search my moving truck. It's a 26,000 pound truck. It's 2 in the morning. And then we're like pissed off. We just drove from Florida. And I'm like driving in, we're driving up to Camp Pendleton, California. And I remember I like pull up to this gate and the guy's like, oh, sir, you gotta go to the other gate. It's like, oh. So I get to back this big ass truck like down this road, get to the other gate, it's closed. Go back to the first gate, like, all right. And like, I'm Marine, so we talked to our misfits a little differently. It's like, hey motherfucker, like, you sent me the wrong gate, like, it's 2 in the morning, what the hell's going on? He's like, oh, I forgot, sir, it's closed. He's like, but I do need to search your truck. I was like, you're gonna search my moving truck? He's like, yeah, we are. I was like, you in what army, bro? And he's like, it literally, I kid you not, literally was like, and like 6 like E1s come like marching out with like mirrors and shit, and they inspect the entire vehicle for like 2 hours. With my, Peyton's there, she's acting too, she's like about to lose her mind. And we finally get to the hotel, and we get to the hotel, and they're like, oh, I booked a dog room. They're like, oh, you can't bring your dog inside. And I was like, I fucking hate this place. And I like lost it. And that was the first fight we were at. So please God, do not go to El Paso, Texas, and don't go someplace because it's like, oh, I can get a really cheap ass house in wherever, and that's not gonna make you happy. And also, I can tell you from experience, the big expensive house in Greenwich, also not gonna make you happy if you hate your job. So don't pick based on a house. Find a job that you like. Find something that brings you some satisfaction. Like, I hope I can make UMortgage grow, like we did with some other ventures. But I can tell you I'm a whole lot happier serving my veteran community and like something I actually care about than I was making slide decks to sell beverage company A. That was terrible. Does anyone go into investment banking? You'll learn a ton. I mean, you will learn so much, but it's tough.